In this video, I'd like to talk a little bit about financial statements and how they can be used in the business context, right? How do we use financial statements? What information do we get? And through the next several videos, we'll explore how financial statements help managers make better decisions. So what kinds of business organizations do we have? And when they talk about organizations here, they're talking about a form. There are three basic forms. A sole proprietorship is the simplest to establish. It really is just one person, right? So you can start your own business. You don't need to have employees. You just have yourself. Now, it's obviously owner controlled. There's some tax advantages to this, but there are also some disadvantages. The disadvantages being that really if you're not working, you're not making money. So time is eaten up quite a bit when you're a sole proprietor. Partnerships, again, are pretty easy to establish, but now you're going to share control with somebody else. You might be able to pair with another person that has skills that you don't have. For instance, if you have you're a car mechanic, you're really good at doing car things, but you have really no experience at all in business. So if you can partner with a person that knows a little bit about cars and a lot about business and accounting and finance and marketing, then that would be a great partner to combine your skills. And again, there could be some tax advantages with a partnership. The final aspect or form that you can think of is something called a corporation. Now, these are a little bit more difficult to create. It's much easier to transfer ownership. It's a lot easier to get funding if you want to expand. And the risks of personal liability are greatly diminished with the corporation. Now, there are lots of other forms. They're essentially hybrids or combinations of the characteristics of these three basic forms. So who uses financial information? Well, certainly investors are going to use it, right? They want to know how the company is doing. Now, one of the things we know about investors, they don't want to know everything the company's doing, right? Because if you tell them everything that's going on, then you've also told all of your competitors. And there's some information that we want to keep to ourselves. Creditors are certainly part of our investment group. Now, what do they want to know? They obviously want to know if we have enough cash or if we have the ability to make payments on the debts that we have with them. So creditors are interested in cash. They're interested in the volume or the amount of debt that the company has, because that represents a risk that they won't get the cash that we are obligated to pay them. And certainly investors, as when you think of shareholders, right? They're obviously worried about things like profitability. They're worried about the size of the company. They're worried about how we relate to our competitors. Both have lots of information they want, and quite frankly, most of that information is not the same. They have different interests, so they have different things that they may look for. What about the concept of ethics? And ethics, our textbook talks an awful lot about ethics, but essentially what we need to be concerned about as investors excuse me, is we need to understand what the company is doing from a more of a values perspective, right? So ethics has to do with fraudulent information, illegal activities, those types of things. And of course, if companies participate in these unethical, illegal things, it's going to have impact on the value of the company because the owners are going to lose faith in the values of the company itself. Now, there is lots of regulation out there to help us control some of this behavior. One of the acts that you'll hear lots of people talk about is something called the Sarbanes-Oxley Act. And it's a rather detailed piece of legislation, but essentially what it does for us as investors, what it does for managers to a certain extent, is that it provides a level of transparency. It provides a level of quality so that we can take the information that we're given and we can utilize that information and feel fairly certain that the information we have is true and accurate. So let's now think a little bit about activity in a business. There are really three things that financial managers do, right? They finance, right? They go out and they gather funds so that they can utilize that in the business. Now, how do they utilize this? The primary reason for financing is not for operations per se. The actual use of financing is to purchase assets so that we can utilize that in the business. So we'll have some short-term financing because we need to buy inventory, and we might not want to pay cash for that. We might want to borrow short-term for that. We also want to buy some plant and equipment. Now, if we're using financing to run the company, like pay the electric bill, or we borrow money so that we can pay our employees, that is not a good use of financing. Investing, obviously, is all about buying assets, the actual assets themselves. So we need to understand how we can explore. Different techniques can help us analyze the projects that we want to do and figure out which are the best. And then finally, our operations, right? We want to run the company. And in the end, this is really what the accounting information system helps us do. It helps us keep track of these activities in the business. So where do we go to get finances, right? Where do we go to finance the company? Quite frankly, there are only two sources, right? You're either going to borrow it or you're going to use shareholder money. So borrowing money, we all know that. We call them liabilities. We know there's interest. We know that there's a principal that have to be paid back. And we know that this could be short-term or it could be long-term. As far as selling shares, right, we could sell shares. Certainly that is a source of financing. But one of the things that we've kind of left out here is the idea that we could use profits. We can take the profit of the company and reinvest it in the company as well. So selling shares and using profit are both examples of using equity to invest or finance for the company. So what are the investing activities, right? We're going to buy resources, right? Assets, right? So we can buy securities of another company, or we can buy things like plant, computers, trucks, furniture, etc. So this is the general ideas here. We have projects, we have assets that we want to buy, and we need to determine which ones are the best for us to buy. As far as operating activities, right? Once we have our assets, we got to start the business. So we need to keep track of revenues, right? Is the money coming in? Are we making sales? Can we analyze that information? Do we need inventory? Do we have enough inventory? Where should we be buying our goods? Accounts receivable. We're going to have to sell things, quite frankly, pretty often. We're going to sell our products to, especially other businesses, on credit. It's an accounts receivable. It's an interest-free loan. We have to do this because that's the way business is done. So now, once we have assets, we now begin operations. Now we have to control expenses. And I really like to use that word. I don't think many textbooks really emphasize that as much. But when you look at expenses, you need to control them. You're going to have them, right? You can't run a business without expenses. But we want to make sure that we monitor and control the amount of expenses in the company. Of course, we have liabilities that come from some of these expenses. Accounts payable, primarily for things like buying inventory. And in the end, we want to know whether we have a net income and or a net loss. So this is our beginning picture, if you will, of the beginnings of a company, right? If you're going to start a business, these are the things we're going to have to think about while we're running that particular business. I look forward to seeing you in the next video.